Thank you so much. I'm very happy to be one of the speakers helping to wrap up a great first day of what every year is a terrific conference. And to see it all unfold for the first time in this virtual space has been great. I think that this first day has done a very effective job of setting the stage around some of this conference's key themes of integrating impact investments into an institutional portfolio and catalyzing capital, particularly private institutional capital, to support financing of impact, tackling some of the most pressing global challenges. In the earlier sessions today, we heard about investing for a sustainable recovery. We heard from panelists about their approaches to mainstreaming SDGs and sustainability in institutional investing. We heard about impact measurement and how to move from theory to practice. And critically, we touched on how to move from immediate pandemic response to longer-term recovery. And I'm going to try to weave several of these themes together in my comments. A key idea across many of these panels and presentations has been the impetus to address both an immediate and a longer-term need to intermediate capital into developmentally impactful priority geographies, sectors, and themes. And all of the players working in this space, everybody at this conference, are looking for the most effective products and instruments to do that. This is an urgent, immediate need in the context of COVID, but it's a need that existed prior to COVID and will continue to be a need after COVID recedes as the dominant frame around all of our lives. So I'm going to spend a few minutes talking about the situation we're all in with COVID and some of IFC's work in bringing more capital to emerging markets to support private companies working in high impact areas, helping them to survive the crisis and to thrive going forward. So let me just recap the context of what we're currently living through in case anybody's missed it, and then I'll focus the lens a little on IFC's work in this landscape. As we're all no doubt far too aware, a key action that governments undertook in response to the COVID-19 pandemic was to effectively shut off their economies almost entirely, curtailing the capacity of billions of people to both produce and to consume, and structurally forcing the world into a deep recession in order to save lives. These policies have disproportionately affected the poorest people in every country and have affected the poorest countries the most profoundly. In the first 2 months after the pandemic began to spread globally, emerging markets saw outflows of $90 billion of debt and equity, surpassing by far in volume and speed the levels observed during the global financial crisis. That $90 billion refers to liquid stock and bond markets, which are generally the first asset classes to be impacted by a global flight to quality and safety. Private equity and debt markets are less liquid, and outflows take longer to materialize. But what we saw in the global financial crisis was that there were sharp declines in emerging markets, private equity fundraising and investment following the crisis. It wasn't until 2017, a full 9 years post-crisis, that emerging markets fundraising achieved the levels seen in 2008. And it's reasonable to assume that we'll see a similar pattern with COVID, investors fleeing emerging markets for developed markets, and a sharp downturn in private equity markets specifically. While emerging markets companies of all sizes are impacted by these dynamics, companies in the mid and lower mid-market face particular difficulties in access to capital. Even prior to COVID, access to finance was already a key constraint on the growth and viability of smaller companies, and the smaller and less established the company, the more challenges it generally faces in accessing funding. IFC estimates that 65 million firms, or 40% of formal micro, small, and medium enterprises in emerging markets, have an aggregate unmet financing need of $5.2 trillion, and that estimate was generated pre-COVID. Given that SMEs represent 90% of businesses worldwide and 70% of formal jobs in emerging markets, the capital crunch associated with the crisis will have a direct impact on employment and job creation throughout the emerging world. So, we've seen a severe outflow of equity and debt from emerging markets. We know from prior crises that private equity fundraising and investment in particular take a long time to recover following a crisis, and we know that these dynamics are hitting small companies the hardest. I've spent a few minutes on this theme because the arena in which IFC operates is channeling equity and debt to private sector companies, and the part of the organization that I work in focuses specifically on private equity mobilization. So now I'm going to touch on what the IFC organization has done so far in terms of COVID response financing, and what we have in the works to lay the groundwork for ensuring that companies have the private equity that they need, not just for survival during COVID, but for sustainability thereafter. With these COVID-related capital outflows and corporate financial challenges as a backdrop, the World Bank Group moved very quickly back in March to approve a $14 billion fast-track COVID response financing package, of which $8 billion is being provided through IFC. This IFC Phase 1 response has 4 components. First, $2 billion to expand IFC's global trade finance program, which provides trade finance through client banks. $2 billion in a working capital program to be intermediated through client banks to businesses to shore up their working capital requirements. $2 billion in a real sector crisis response facility to support existing IFC clients in the infrastructure, manufacturing, agribusiness, and services industries. And finally, $2 billion for the Global Trade Liquidity Program and the Critical Commodities Finance Program. So essentially, this was $8 billion to support existing clients, working both directly with the IFC clients and with client banks to channel money to their customers. And the uptake was significant. By May, the World Bank announced that its emergency operations to fight COVID had reached 100 developing countries, the largest and fastest crisis response in the World Bank Group's history. So this was basically the group's war chest that the bank and IFC had that they could deploy from their own balance sheets to address the immediate needs of existing clients. And this was an amazing initiative approved in response to an urgent crisis. But that was just Phase 1 of the response. We are now entering Phase 2, where the focus is on further stabilizing companies with both liquidity and growth capital and creating a foundation for renewed growth. And in this phase, we need to think about how to widen the lens, how to get more money from more players into these markets to help more companies. So we need money coming from players outside of IFC, and we need that money going to existing and also new clients, both larger companies and SMEs, both directly and in collaboration with other players. One thing that IFC prides itself on is its convening power, its ability to bring different players together. And with regard to this specific set of priorities, IFC has a private equity arm, the IFC Asset Management Company, or AMC, which was designed to bring outside equity investors into IFC projects and which is expected to be deployed to support the next phase of COVID response. AMC was set up in 2009 as IFC's equity mobilization platform. Its mandate was to go outside of the organization and raise money from outside investors, and then co-invest that money through private equity fund structures alongside money from IFC's balance sheet. Over the past decade, AMC has raised over $10 billion and managed a dozen funds focused on different sectors, regions, and strategies. AMC was originally set up in part as a response to the 2008 financial crisis, so it's fitting that today, with the world once again facing economic downturn, that AMC would seek to play a pivotal role in channeling capital back into emerging markets. In that context, IFC and AMC intend to continue launching new private equity funds, as well as funds of funds, which will invest money from IFC's balance sheet and money from external investors into companies and funds across emerging markets. It's contemplated that these new funds will be structured as tracker funds, investing into a slice of IFC's business without an additional layer of investment selectivity. So essentially, there'll be funds that allow outside investors access to the full range of IFC's investment activities. In the first phase of fundraising, we would seek to target governments and players in the international development arena who have similar developmental and return mandates as IFC and who are therefore more likely to invest in times of crisis. As the recovery picks up, IFC will consider raising capital from other investors returning to emerging markets. This is a way for IFC to play a dual role as a key provider of capital in the short term and as a key mobilizer of capital in the medium term. Now, for any of us who are contemplating raising impact-oriented products, it's encouraging that there seems to be an expanding universe of investors who are like-minded in their appetite for both returns and also credible development impact on the ground. And I want to talk for a couple of minutes about IFC's approach to development impact measurement and monitoring. If a deal meets IFC's threshold for financial viability, it's then assessed for anticipated development impact. Selectivity for development impact is at the core of IFC's work, both in direct equity investing and in fund investing. And the tool for evaluating that impact is the AIM framework, or Anticipated Impact Measurement and Monitoring Framework. This is IFC's proprietary tool that evaluates every deal that the organization transacts and puts a numerical score on its anticipated development impact as measured through the two pillars of project-specific outcomes. So what will this one company or transaction achieve on the ground? and market creation outcomes. What will this one deal contribute to the broader project of creating markets that are conducive for private sector investment? This numerical scoring system allows for consistency and comparability of transactional impact across the IFC portfolio, and it's important in that it makes deal selection around developmental criteria a deliberate exercise. Every deal that IFC does has been judged as having a reasonable expectation of achieving development impact as assessed through the AIM framework. I also want to touch here on the notion of mapping the development outcomes of new products to the SDGs. As we're all aware, the SDGs are a framework developed from primarily a public sector vantage point, and the exercise of mapping private sector deals to SDG results is not particularly straightforward. However, broadly speaking, IFC's results reflect quite meaningful SDG impacts as a consequence of IFC investments, which helps to substantiate the anticipated impacts that were articulated at the AIM scoring stage. In addition to its thought leadership in the impact space, IFC has, of course, long been a leader in ESG standards and compliance, which I mentioned because although ESG is distinct from development impact in many ways, the two intersect in that they both seek to achieve sustainable results that benefit host countries and communities. So every deal in which IFC invests benefits from the institution's expertise to ensure that these standards are met and maintained. Now, wrapped around all of these various practice areas, the AIM framework, SDG mapping, ESG leadership, all of that, is the fact that IFC promoted and is a signatory to the operating principles for impact management, or the impact principles. These lay out a conceptual framework for what it means to manage investment funds with the intent to contribute to the achievement of positive social, economic, or environmental impacts alongside financial returns. The impact principles lay out an end-to-end process covering strategy, origination and structuring, portfolio management, exit, and independent verification. And these elements are considered to be the key building blocks for a credible impact management system. So IFC is a signatory of those principles, and any new products will be managed in alignment with the principles. So essentially, as we're contemplating new private equity products as a part of the phase 2 COVID response, IFC and AMC will be aiming for reasonable risk-adjusted returns, but will also be positioned as leveraging the full complement of IFC's capabilities in the impact space. So I'm going to stop here and just summarize what I've laid out in my remarks. I've tried to use the ideas introduced earlier in the day around catalyzing capital to support financing of impact, and specifically how we move from immediate pandemic response to longer-term recovery. I began by describing the severe consequences the pandemic has had for emerging markets, economies, and capital flows out of emerging markets, and specifically the problem that this is amplified for smaller companies in access to finance, which in turn constrains growth and job creation. I described the COVID response financing packages already deployed from IFC's balance sheet, and then summarized how IFC is turning its attention to phase 2, mobilizing through the AMC further equity to stabilize companies' balance sheets and create a foundation for renewed growth. I touched on fund concepts that are currently being contemplated, and then I ended by describing IFC's approach to evaluating development impact for each deal that would be part of any new fund product. Now, this is just what one organization has done in response to the pandemic, but I hope that it served as a useful example of one model for how DFIs can think about mobilizing capital, particularly in the form of private equity, to support businesses as they begin to emerge from this crisis and to enable them to achieve development impacts on the ground. Thank you very much, and I hope you all have a very enjoyable rest of this conference.